Well, there's been a lot of talk lately about this so-called $72 silver pivot, about France, about China, and about whether something quiet is happening behind the curtain that most people still do not fully understand. So, in this video, we're going to separate signal from noise, and you're going to walk away feeling calmer, sharper, and more confident about what actually matters here. Today is Friday, April 10th in New York, and tell me in the comments what day and date you're watching from. And before we go any further, if you value this kind of work, subscribe and type John A.G. Best in the comments. That support helps more than people realize. Because here's the thing, on the surface the story sounds easy. Silver is trying to hold this big area. Gold is still trading at an eye-popping level. The Middle East throws a new headline at the market every few hours. Oil jumps, then backs off. The dollar wiggles. People get emotional. And then somebody says, there it is. That proves the whole system is cracking right now. Maybe. But maybe not in the simple way people are selling it. So let's start with the noise, because if you don't understand the noise, you can't see the bigger structure underneath it. Over the last several days, traders have been bouncing between relief and panic based on every update tied to Washington, Tehran, Israel, Lebanon, and the Strait of Hormuz. We've had talk of a fragile pause, talk of negotiations, talk of deadlines, and then almost immediately more reminders that none of this is settled in any clean or permanent way. Gold pushed back toward the upper 4,000 range. Silver climbed back into the mid-70s. Oil cooled after truce headlines, and then stayed twitchy because the route everybody keeps watching still matters enormously. So yes, the market has been headline-driven. Absolutely. That part is real, and when I say headline-driven, I do not mean fake. I mean fast. I mean emotional. I mean you can wake up to one version of the story, go get coffee, come back, and the entire mood has changed. That is why you get those huge green days and then those ugly red days, and then a bounce that makes everybody think the bottom is in, and then another reversal that makes everybody think the world is ending. This is what a nervous market looks like when geopolitics, energy risk, inflation fear, and rate cut guessing are all wrestling each other at the same time. So if you've been feeling a little whiplash lately, good. That means you are paying attention. But now let's move away from the noise and talk about why the 72 conversation survives. Because I do think that level matters. I just do not think it matters in the lazy, magical meme version way people present it. To me, 72 is not some sacred line drawn by heaven. It is not a prophecy number. It is not a guarantee. It is more like a pressure test. It is the area where the market keeps asking a serious question. Are buyers actually willing to defend strength after a violent run? Or was the whole move just a blow-off that needed time to cool down? That is the real question today. And if you look at the way silver has behaved since that wild spike earlier this year, I think the answer has been more constructive than people realize. Remember, this market ripped to ridiculous heights, then got smacked, then scared a lot of late buyers, then started rebuilding. That is normal after a vertical move. What would worry me more is not a fast drop after a euphoric surge. What would worry me is a total inability to stabilize afterward, but that is not what we have been seeing. Recent market updates had silver down in the mid-60s during the February washout. After that, it clawed its way back, and by early April it was trading back around the mid-70s. Another widely followed bank has even been saying the metal may spend much of this year chopping around in something like the mid-60s to mid-70s zone before the next bigger directional move becomes obvious. So when people obsess over 72, what they are really circling is a wider holding pattern, not one perfect number to the penny. That distinction matters. Because markets do not owe us precision. They give us zones, they give us behavior, they give us tests. And right now the behavior says silver is trying to turn a chaotic retreat into a base. Now could that fail? Of course it could. If the market loses this whole zone decisively, then I would reassess. I would. You have to. That is just basic discipline. But until that happens, I think the fair way to read this is that silver is digesting one of the most explosive runs any of us have ever seen, and it is doing it a lot better than a lot of people expected. And there's another reason I lean that way. When a market has a fake rally, it usually needs constant excitement to stay alive. It needs fresh hype every day. It needs people to keep screaming. It needs a constant stream of easy believers. That is not what strength looks like. Real strength can survive boredom. Real strength can survive a stretch where everybody gets annoyed because price is not giving them instant gratification. Real strength can survive a period where weak hands leave, tourists disappear, and the market quietly changes ownership. That, to me, is one of the most important parts of this whole story. Because if silver spends a while in this general neighborhood, what is happening? The people who bought the top because they thought it would go straight up forever get worn out. The people who never really believed in the thesis sell into relief. The impatient crowd rotates out, and the buyers left standing tend to be buyers who actually know why they own the metal. That is healthier than a straight line. Let me put it differently. A lot of people say they want a strong bull market, but what they really want is a market that never tests them. Those are not the same thing. And silver, maybe more than almost any other major asset, has a way of testing people right when they feel the smartest. Now, before we go into the bigger macro force behind all of this, I want to hit the paper market issue, because this is where people tend to go flying off the rails. The emotional version of that argument goes like this. Look how much paper silver trades compared with how much actual silver gets mined. Therefore, the whole price is fake, and any day now, physical reality will blow the doors off the system. I understand why people say that. I really do. But I think the smarter way to use that point is a little more careful. Yes, the volume of paper exposure can get absurd relative to annual mine supply. Yes, that gap feels ridiculous. Yes, it tells you price discovery in precious metals is heavily financialized. All true. But financialized does not automatically mean irrelevant. A futures market can be distorted without being useless. A paper market can dominate short-term price action without invalidating the long-term physical thesis. And if you miss that distinction, you start expecting some instant end-of-the-world moment that the market simply may not give you. What matters more, in my view, is whether the physical backdrop is tightening or loosening underneath all that paper churn. And based on the latest market outlook, this silver market is still not exactly swimming in easy excess. Current projections point to another annual deficit this year, which would make it several years in a row. Total supply is expected to rise a bit, helped by more recycling and a small increase in mine output. But physical investment demand is also expected to rebound hard while available metal still has to serve industry, investors, and inventories at the same time. That does not mean a straight line higher tomorrow. It does mean the fundamental backdrop is not as soft as a casual glance would suggest. Now here's where I want to push back on one popular silver talking point. A lot of bulls speak as if solar demand alone is going to light the fuse and send the metal into orbit no matter what. I get the intuition. Solar is massive. The build-out is real. It is accelerating globally at a speed that would have sounded crazy not long ago. In fact, based on recently published energy forecasts, solar is expected to account for nearly 4/5 of global renewable capacity expansion over the next several years. That is not small. That is gigantic. But here is the part people skip. Even with that huge solar build-out, recent silver demand estimates still show industrial fabrication dipping this year, partly because manufacturers keep finding ways to thrift silver use or substitute away from it in photovoltaic applications. In other words, the bullish demand story is real, but it is not as simple as more panels equals automatic silver moonshot. Technology adapts, engineers optimize, markets respond. So the honest case for silver is actually stronger when you stop overselling the easy version. And that brings us right into the bigger force, because the real monster under this story is not one truce headline, not one chart pattern, not one futures session, and not one viral post about paper ounces. It is trust. It is trust in currencies. It is trust in reserve systems. It is trust in settlement. It is trust in what countries will hold when they start worrying less about return and more about control. That is the real story. Based on recently published reserve data, the dollar's share of allocated global reserves finished last year down in the high 50s. Not zero, not collapsing overnight, but still sitting near multi-decade lows. At the same time, gold demand last year crossed a historic threshold. Exchange-traded holdings had one of their strongest years on record, and official sector buying kept showing up even after the metal had already made stunning new highs. Then this year, central banks kept buying in February as well. That is not a one-week trade. That is a pattern. And I think another thing people miss is just how much institutional language has changed. Not long ago, a lot of big money commentary treated gold almost like an embarrassing relic, something you mentioned for tradition or insurance and then moved on. That tone has changed. Now you are hearing some of the largest desks in finance talk openly about higher long-term gold levels. Not because they suddenly became romantics, but because they are looking at reserve demand, fiscal pressure, currency dilution risk, and the simple fact that once a market starts repricing monetary distrust, it can travel a lot farther than the old models assume. That shift in language matters. Institutions do not have to love gold for the gold move to continue. They just have to stop underestimating why other people love it. And once gold gets that institutional permission slip, silver usually stops being viewed as this weird side character and starts being viewed as leverage on the same macro idea. Not perfect leverage, not clean leverage. Sometimes it behaves like money. Sometimes it behaves like an industrial metal. Sometimes it behaves like a stress test for your patience. But when the precious metals complex as a whole gets re-rated, silver does not need its own entirely separate universe to work. It just needs enough reasons to stay relevant while gold drags attention back toward the sector. That is why I keep emphasizing the word convergence. Take the chart. On its own, the chart is interesting, but not enough. Take the physical deficit. On its own, that helps, but not enough. Take the reserve story. On its own, that is powerful, but it points more directly to gold than silver. Take the energy story. On its own, that creates volatility, but not certainty. Take the industrial story. On its own, it is mixed. But put those things together and suddenly you do not need every single pillar to be perfect at the same time. You just need enough of them pulling in the same broad direction. That is what I think we have. And let me say something else about the chart, because people hear the phrase support zone and think it means comfort. It does not. Strong support often feels terrible while it is being formed. It feels indecisive. It feels annoying. It feels vulnerable. It feels like the market is wasting your time. Support only looks obvious later, after the market has already moved away from it. While it is forming, it usually feels like punishment. So if silver does keep chopping around here for a while, that would not automatically bother me. In some ways, it would make the structure more believable. A market that can hold together after a euphoric mania phase, after margin changes, after profit-taking, after disbelief, after non-stop macro headlines, that is a market telling you demand still exists even when the easy excitement is gone. And if you want one practical example of why I think strategic demand matters, look at what has already happened with official sector gold buying. For multiple years now, central banks have been buying at levels that would have sounded extreme not long ago, and they kept doing it even after price ran hard. That tells you this is not tourists chasing momentum. This is policy behavior. This is reserve behavior. This is the kind of demand that does not ask, can I flip this next week? It asks, do I want more of this on my sovereign balance sheet if the next decade gets uglier? That is a completely different mindset. So yes, I think the next several weeks matter. I think the next several months matter even more. But I also think people can get too locked into the short calendar and miss the larger point. If this is really a transition in how the world thinks about hard assets, then the most important development will not be one daily candle. It will be the repeated refusal of the bigger thesis to die. Even after corrections, even after scary headlines, even after the crowd gets tired of hearing about it. That is exactly what I am watching, over and over. And tell me this in the comments too. Do you think silver is building a real base here, or do you think this is just a temporary pause before another deep flush? I'm genuinely curious where you stand, and once you see that pattern, a lot of things that feel random start to line up. Countries are not all making the exact same decision for the exact same reason. Some want insulation from sanctions risk, some want diversification, some want political optionality. Some simply do not want all their strategic insurance tied to one issuer forever. But whatever the reason, gold has been moving back toward the center of the conversation. That matters for silver, even though silver is not the primary reserve asset. Why? Because gold moves first in the monetary imagination, and silver often follows once people start broadening the precious metals thesis. Gold gets re-rated as serious money, then silver gets rediscovered as the more volatile, more industrial, more emotional cousin that still rides the same trust cycle. That is why I do not think this is only about jewelry demand, or only about industrial demand, or only about a rate cut, or only about a war. It is bigger than that. And by the way, if you're successful, share your success story in the comments so others can stay motivated. Now let's talk about the part of the story that gets people the most worked up: China, France, and the idea of hidden settlement. This is where I want to be very careful. Do I think gold is becoming more relevant to how nations think about reserves, power, and financial safety? Yes. Do I think countries increasingly want assets with no one else's liability attached? Yes. Do I think gold is quietly gaining monetary importance even when officials avoid saying it too directly? Yes. Do I think we have clean public proof that the United States is literally shipping gold to China to settle trade in some direct, obvious, headline-ready way? No, I do not. And I think people should be honest about that. What we do know from the latest publicly available U.S. government reporting is that the bilateral imbalance with China is still enormous, running in the neighborhood of $250 billion on a goods and services basis over the relevant recent period, with the goods gap even larger. That is real. That is documented. That is a giant structural relationship. But a giant imbalance by itself is not proof of secret bullion settlement. It just creates the kind of backdrop where people start imagining alternative channels of adjustment. So my position is this. I would not dismiss the idea that gold is showing up more often around collateral, sovereign strategy, or discrete forms of settlement at the margins. I would not dismiss that at all. The world is changing. But I also would not pretend we have a smoking gun every time somebody tells a dramatic story on the internet. That is not skepticism against gold. That is respect for evidence. And weirdly enough, that makes the thesis stronger, not weaker. Because if gold is gaining importance even without a sensational confirmed story, then the move is broader and more durable than one secret deal. Now, France. This one is fascinating because the truth is actually more interesting than the cartoon version. The cartoon version says France pulled gold out of New York as some giant anti-dollar rebellion, and that this proves the old order is already dying in public. The reality, based on the latest official and market reporting, is more specific. France upgraded a chunk of older bars, kept the total size of its reserves unchanged, and moved the newly compliant bars to Paris rather than New York, because the trading standard and market practicality made that location more useful. Officials explicitly said the move was not politically motivated, so no, this is not clean proof of a dramatic monetary divorce. Not by itself, but hold on. That does not make it meaningless, because symbolism matters in reserve management. Control matters, location matters. The ability to mobilize your metal in the market you prefer matters, and the fact that gold keeps coming back into these conversations at all tells you something. Even when officials describe a decision as operational, gold is still being treated like an asset worth optimizing, standardizing, safeguarding, and positioning carefully. Countries do not do that with things they consider irrelevant. So, no, I'm not going to sell you fairy tales here. I am not going to tell you one French decision means the dollar is dead by next Tuesday. I am not going to tell you one rumor about China proves the entire global system has secretly flipped already. But I am going to tell you that when reserve data weakens for the dollar, when official gold demand stays strong, when some of the biggest financial institutions on earth keep lifting price targets, when insurers in China are being allowed into gold on a pilot basis, and when countries keep showing they care very deeply about where their metal sits and how it can be used, you are watching the architecture shift, even if it is happening slower and messier than people want. That is the heart of it. This is not a movie where one scene changes everything. This is a long transition where one brick gets moved, then another brick gets moved, then another one, and most people do not notice until half the wall looks different. And there is a historical echo here that matters. We have seen periods before where governments told the public one thing, markets sensed another thing, and precious metals slowly moved from the margins back toward the center. Not always in a straight line, not always with fireworks, but the pattern is familiar. Confidence stretches, policy improvises, promises multiply, and eventually, people want something that does not depend on somebody else being disciplined forever. That is why gold and silver keep coming back. Not because they are trendy, because trust cycles keep coming back. Now let me tie this back to the 72 pivot one more time, because this is where the whole script comes together. If short-term noise keeps whipsawing the market, that can make silver look weaker than it really is. If paper volume keeps dominating day to day, that can make silver look more artificial than it really is. If solar headlines get oversimplified, that can make the bullish case sound dumber than it really is. If viral posts overstate the France and China angles, that can make the monetary case sound crazier than it really is. And all of that creates an opportunity. Because when a real thesis gets wrapped in sloppy arguments, serious people back away from it longer than they should. That is what I think has happened here. The best case for silver is not one chart. It is not one war. It is not one rumor. It is not one bank target. It is not one reserve table. It is not one shortage headline. It is the convergence. It is the fact that silver sits at the intersection of monetary anxiety, industrial relevance, investor psychology, and a precious metals complex that is already being revalued by the global market. That is why I keep coming back to it. And let me add one more thing that I think people underestimate. Gold and silver are not just American stories. They are not even mostly American stories. They are global stores of memory. That is the way I think about them. A bond can be useful. A stock can be brilliant. A currency can be convenient. But gold and silver carry something different. They carry inherited recognition. Across borders, across systems, across political eras, people may disagree on price, but they rarely need an explanation of what the metal is. That universality matters more, not less, when the world gets politically messy. Now, none of this means silver goes straight up from here. It does not. In fact, I would be shocked if it did. This market has become too emotional, too widely watched, and too headline sensitive for that. There will be more fake-outs. There will be more nasty intraday reversals. There will be more moments where somebody declares the bull market over because silver dropped hard on a Tuesday. There will also be more moments where people get carried away and start shouting absurd upside numbers, as if timing does not matter. You need to stay balanced. That is the whole game. Balanced, but not blind. Open-minded, but not gullible. Bullish, but not sloppy. If this zone holds, if the broader precious metals complex stays strong, if reserve diversification continues, if official demand remains firm, And if physical investment keeps improving into weakness, then I think the odds are good that today's frustration becomes tomorrow's foundation. That is how I see it. And yes, I do think 1 year from now, a lot of people will wish they had spent less time staring at every intraday candle and more time understanding the structure. Because what is the bearish case, really? That confidence in fiat improves dramatically? Maybe. That geopolitical stress fades completely? Maybe. That energy risk disappears? Maybe. That countries stop wanting reserve diversification? Maybe. That investor interest in precious metals goes quiet even after a historic gold re-rating? Maybe. Could all of that happen? Sure. Markets are humbling. Anything can happen. But do I think that is the higher probability path right now? No, I do not. And one more subtle point before I close. When people hear de-dollarization, they often imagine a clean replacement, like one new king taking the throne. I do not think that is the most useful way to think about it. The more realistic version is fragmentation. A little less automatic dependence here. A little more local settlement there. A little more gold and reserve strategy. A little more hedging against sanctions, payment friction, and policy uncertainty. In that kind of world, the dollar can remain dominant and still lose a bit of unquestioned privilege at the margin. That is enough to matter. You do not need the dollar to disappear for gold to benefit. You do not need a formal gold standard for gold to matter more. And you definitely do not need some instant financial apocalypse for silver to do well. That is one of the biggest mistakes retail investors make. They think the metals thesis only works if the world explodes. No. Sometimes it works because the world does not explode, but trust keeps eroding anyway, slowly, quietly, relentlessly. And that, to me, is a much more believable setup. So where does that leave us right now? It leaves us watching the short term without worshiping it. It leaves us respecting the chart without pretending the chart is destiny. It leaves us paying attention to reserve data, official buying, energy choke points, and trade imbalances without turning every data point into a conspiracy thriller. And it leaves us with a silver market that, in my opinion, is still trying to build something important after a violent reset. If that build continues, then 72 will not be remembered as some random internet number. It will be remembered as the kind of area where conviction got tested, where tourists left, where believers got more selective, where the market stopped performing for the crowd and started handing ownership back to people who could actually sit through uncertainty. That is what I think is going on. Could I be early? Absolutely. Could I be wrong? Of course. But based on the way the pieces are lining up, I think the bigger mistake is treating this as just another temporary commodity trade with no monetary meaning behind it. I think it has more meaning than that. A lot more. So keep your eyes on the zone. Keep your eyes on the reserve story. Keep your eyes on the official demand story. Keep your eyes on the Hormuz story, but do not let it hypnotize you. Keep your eyes on the broader precious metals complex. And most of all, keep your mind clear enough to recognize that some of the strongest setups look messy, precisely because they are strong enough to survive disappointment. That is where we are. We are not in a clean, easy, obvious story. We are in a powerful, noisy, unfinished one. And those are usually the stories that matter most. Thanks for being here. And just remember, this is for education and market discussion only. I'm sharing how I'm interpreting the setup, not telling you what to buy, sell, or chase. You still have to think for yourself, manage your own risk, and make your own decisions like an adult in a real market.